Hello, good morning. Once again, welcome to the session. Today also we'll continue the roles of debit and credit. Because this session, as I told you, this session is very, very important. If you are very strong in debit and credit, finding debit and credit, it means in journal, it will help you in all other areas like recording. This is recording, actually this is recording journal, debit and credit, deciding debit and credit. After, if you are good in journal, posting to ledger, classifying, then summarizing, finalization, preparation of final account, income statement, balance sheet, and trial balance also. Trial balance, income statement, balance sheet. And after that, analysis. The analysis means ratio, fund flow, cash flow, all areas. In accounting from A to Z, it is needed debit and credit. You should, that much important is there for debit and credit. So we'll continue the session. I'll go to the slide. So we have done, yesterday we have done few accounts we have done. Now today we'll continue that session. We'll continue that from there. That means some area, some transaction we have done already. Now we'll do the same thing but different transactions. But by this also, I think one more session we'll do this as considering the importance of this area. You should be very clear about debit and credit. Then we'll go to the next area. It is better. Otherwise, I think it will be difficult to understand. Okay. So this is March 1st. There is one transaction. Paid salary. This also you have to understand. There are, yesterday we discussed two approaches. One is modern approach. One is traditional approach. That should be there. That you have to remember always. There are two approaches. Normally we are following, for example, SCCA guidelines. As per SCCA guidelines, we are following all the transaction or from recording transaction from journal, ledger, final account. All we are following the modern approach. Even though I find it is sometimes you will find easier the traditional approach for application. So we'll discuss both. And after that, after understanding both the approaches or both the methods, then we'll stick on one. We can do all our the rest of the work we'll do according to the modern approach. So once again, I will discuss that modern approach. In modern approach or American approach, the total accounts are classified into 5 groups. That you have to, it is better you always remember the same order. First asset, then expense, liabilities, equity or capital, and revenue or income. 5 groups. That why I tell you first to remember the same order, because the asset and expenses are having same rule. Asset and expenses, when increasing, it will be debited, and when decreasing, it will be credited. Or when assets and expenses, when you debit, it will increase. When you credit, it will decrease. Then the rest of 3, liabilities, equity or capital, and revenue or income. These 3 groups, just opposite. When you debit, it will decrease. When you credit, it will increase. Or for an increase, you have to credit. For a decrease, you have to debit. This is the rule. Then traditional rule, according to traditional rule also we discussed. According to traditional rule, we have 3 groups, 3 category of accounts. One is personal, real, nominal. Personal account, what is the meaning of personal account? Personal account is the accounts of all persons, companies, associations or institutions. Accounts of person, companies, institutions, organizations, or any type of associations. It is coming under personal account. Then real accounts are the assets of accounts of assets and properties. Assets and properties. Asset, you know already, different type of asset, usul, and properties, akarat. So for this real account, and there is nominal accounts are the accounts of expenses, losses, incomes, and gains. Nominal accounts are the accounts of expenses, losses, incomes, and gains. Now, what is the rule? When the real account rule, personal account rule is debit the receiver, credit the giver. The person who receives, his account will be debited. The person who gives, his account will be credited. Then other real account means real account, what is it? Debit what comes in, assets and properties. If it comes to the business, debit. Credit what goes out. If anything goes out, any assets or properties goes out, it will be credited. Then what is nominal account? Debit all expenses and losses and credit all incomes and gains. This is the traditional rule. So these two rules we discuss always. You should remember these two rules. Then it will be very helpful for you to decide the debit and credit aspects. So first we'll discuss now. We are doing now. First you have to understand we are doing with the modern approach. So what is the first transaction is salary, paid salary 200 riyal. Paid salary. First you decide the two account. You know already there are two account here. Cash is paid and salary is an expense. So salary and also cash. These are the two accounts. After that, class of account you have to decide. Salary is an expense. You know already salary is an expense. And it's an indirect expense that also you have to understand. Just like cash is also a current asset, but cash you can write asset here because current asset and fixed asset or current or non-current or tangible or intangible, whatever the asset may be, its rule is same. For all assets, same rule. So there is no need to specify here which asset, but you have to understand that. So now you have to understand increase or decrease. When you pay salary, your expense increases. When you pay cash, your cash balance decreases. In business, cash balance in business decreases. Now, when expense increasing, the rule you have to apply. When expense or asset increasing, it will be debit aspect. When assets or expense decreasing, it will be credit aspect. So it is very clear. Now salary account is debit and cash account is credit. Now we'll go to the next one. Paid electricity. Electricity also same. It is an expense. So electricity expense and also cash. Cash is a asset going out. Cash is going out. So anyhow, electricity is an expense, and cash is, you know already, it is an asset. Cash is an asset. Then when you pay electricity bill, karba, when you pay electricity bill, your expense increases. When you pay the cash, your cash balance decreases. So expense increase means the rule debit, and cash decrease means credit. So it is very easy now. If you remember the rule, it is very easy. There is no more difficult in doing this. Now next is repaid loan to bank, 5,000. Before you took loan, now you repaid the loan. When you took the loan, you remember already, your cash is increasing and bank balance or bank loan Bank loan is a liability, liability is increasing. So when you're taking loan, so that we know already, now you are repaying the loan. Ragya. So what happens? Two accounts, there is no difference. Bank. Bank, when you write, it is always, remember, you mention it is a loan, bank loan. Because in bank, there may be deposit also may be there. In case of deposit and loan, when you take loan from bank, that is qard. When you deposit dafa, or what you call the investment or deposit, investment, that means what is the word? It's small. When you invest money in bank also, if you are both are treating as bank, it may confuse you later. So when you deposit money, bank you write, in bracket you write deposit, because it is very important in when you are doing the tally, tally ERP9 or any other software, you have to understand clearly what is this. Otherwise you will confuse. Deposit it is an asset. Bank when take loan is a liability. So you will confuse that. So always whenever it's their bank, you mention whether it is loan or whether it is a deposit, qard or istismar. So it whether it is you have to clear. So when you repaid the loan, there are two accounts. One is bank and second is cash. Now bank loan is a liability, and cash is an asset. Cash is an asset. Now, when you take loan from bank, your liability, your mas'uliyat increases. So, liability increases. No, when you repay the loan, this is repayment, not taking. So, when you repay the loan, your liability decreases. And when you repay the loan, your cash also decreases, because you take money from your office and pay the bank loan, repay the bank loan. So your cash decreases, your liability also decreases. Now, when liability decreasing, what is the rule? It is, we know already, liability coming in the second part, that liability, equity or revenues. When increasing, it will be credited, decreasing, it will be debited. Then first one, asset and expenses. When increasing, it will be debited. When decreasing, it will be credited. You can understand now, there is one debit and one credit. So in all normal simple entries, there will be one debit. Minimum there should be one debit and credit. But in some cases, there may be 2 or 3 debit and 1 or 2 debit credit also. It may be more. That type of entries are called compound entries. So after completing, after understanding the normal transactions, after doing, we'll start some compound transaction, having 2 or more than 2 accounts. That is very important to understand, because there are more chances of mistakes are. So goods return to Nizwa traders. So goods return, this is a case of return. Ragya. So this is a topic to be very clearly you have to understand. Goods return to Nizwa. There are 2 types of returns are there. One is purchase return, Mushtariyat Ragya. Another is sales return, Mubiyat Ragya. You sold goods and the customer returned to you. The first one is purchase return. You purchase goods and you return to the supplier. The return is mainly because of so many reasons. There may be returns. For example, the goods may be defective goods, or may be not according to your prescription. Price may be different. Quality may not be fulfilling. So many reasons may be there. Because of that, customer may return the goods. Sometimes the goods may be different. Parcel may be you sent. Different goods delivered. That also may be case. Any reason you may return some goods after, for example, you bought 5,000 real worth of goods. After that, 500 or 250 real goods, it is not according to your order. So you can return that. Just like you sold goods to customer and customer finds some of the goods are defective, broken or damaged or defective. So customer may return the goods to you. This is in case of mostly in case of credit purchase and credit sale, there may be more chances of returns. If it is cash transaction, there are returns, chances will be less. Anyhow, goods returned to Nizwa traders. If the goods return means you return. Goods return to Nizwa traders means you buy before goods, now you return. It is a purchase return. So you have to write the two accounts. One is purchases, returns, and second is Nizwa traders. Nizwa traders. So these are the two accounts. Now you have to understand whether purchase return is debit or credit. And Nizwa traders, these two you have to understand. Nizwa traders, we discussed yesterday, when you buy goods on credit from someone, it is your supplier, the person to whom business owes. It is also called sundry creditors or bills payable. Sorry, accounts payable. Bills payable also almost same. So sundry creditors, bills payable, accounts payable. Actually, I told yesterday, in Tally we term it is as sundry creditors. But in other what you call ACCA material, there all it is for this type of sundry creditors term is not used. Accounts payable. So Nizwa traders is accounts payable. That you have to understand, because you purchased goods but money has not paid. So payable, it is a liability, your liability. Payable is a liability. So now purchase return. Purchase return, what is that? You have to understand. Purchase return is it is a part of purchase. In Tally, we are writing purchase return the group of purchase only. So it is a purchase and purchase return, both are coming under purchase. So you can write it is a purchase, or purchase is an expense. So you can treat it is an expense, or bar as it is purchase. It is a part of purchase. Purchases. So this is purchase returns. So purchase return. Now Nizwa traders is, you know already, Nizwa traders is account payable. Account payable means it is a liability. So now you have to understand, when goods are returned, when you purchase goods, your expense increases. Now some of the goods are not according to your prescription, so you return that. So your expense decreases. Now the Nizwa traders, your liability, it means your account payable. But when you purchase goods, account payable increases. Now some of the goods are not according to your order, according to your price, or any defective goods are there, so you return that. So your liability automatically decreases. So now you can see expense decrease. Asset and expense increase means debit, decrease means credit. Then Nizwa traders liability decrease. When liability is decreasing, you know already, liability, equity and revenue. When increasing, it will be credited. When decreasing, it will be debited. So this is the transaction, debit and credit. If it is you interpret in right way, there is no chance of mistake. But if you interpret in a different way, it may be there may be mistake. But mistake, if it is appears both are debit, if you are getting or credit, it means you have done mistake. So you have to rethink or redefine that. Then Salala traders return goods. This just opposite. Salala traders, your customer, you sold goods before to Salala traders, they returned. So it is Mushtariyat Ragga, sales return. That means it is also called sales return, is also called return inward. inward, dakhili. And purchase return, normally it is called return outward because you return it to the supplier, return outward or kharijiya. So now Salala traders return goods. So the two accounts are, one is sales return, and second one is sales return, and also it is Salala traders. Salala traders. Now you know already sales return. Sales return is a part of revenue because sales is a revenue. Sales return is also a revenue or income or revenue. You can write revenue, or it is a part of sales. Why it is considered as revenue? Because it is a part of sales. Now Salala traders is your customer. They return goods to you. So Salala traders is a customer, or it is a customer, or it is called sundry debtor or account receivable. So you can write it is a Salala traders is as account receivable. That means account receivable is an asset. Sundry debtors, here you have to write asset or liability. So sundry debtor or account receivable is an asset. Asset means current asset. So we can write just asset. Now you have to check about whether Salala traders return some goods. Goods are returned from Salala traders. Your sales or revenue increase or decrease. When you sold goods, your revenues are increasing. And some customer returned the goods, you means revenue decreases. Your revenues are decreasing. Just like Salala traders, your asset, the person who owes money to you. But when you sold the assets, your account receivables are increasing. Now some of the goods are returned to you. Just like they are giving some money, your asset decreases. Just like now what happened, some of the goods they return to you, so your asset decreases. So asset decreases. Now you can check what happens. Sales return or revenue decreases. You know already the second part of the rule, that means liability, equity and revenue, when increasing it will be credited, decreasing it will be debited. Just like when asset and expenses increasing it will be debited, decreasing it will be credited. So if you got the debit and credit, it means it is correct. If you define it will be okay. Otherwise, if you are getting misinterpreting, so you will get maybe 2 debit or 2 credit. So these are the case of some more cases. We have more and more cases we have to do, but we'll do small questions so that you can get the clear idea. Now we have to do the same transaction by using traditional approach. Traditional approach, it means the 3 accounts. Traditional approach means you have to understand classification of 3 accounts: personal, real, nominal. Don't think about 5 account, 5 types of account: asset, expense, liability, equity and revenue. That is the first classification. Here 3 accounts: personal, real, nominal. Once again, personal, real, nominal. So first you define 2 accounts. 2 accounts are, there is no any difference whether it is whichever the approach is there you are applying. The 2 accounts there is no change. So here the 2 accounts are salary and cash. But the interpretation will be different. Class of account will be different. Salary is, you have to check whether it is personal, real or nominal. Salary, nominal account is, first you 3 account, you once again I will repeat. Personal account is accounts of person, companies, banks or any other associations or organizations. Real accounts are the accounts of assets and properties. And nominal accounts are the accounts of expenses, losses, incomes and gains. Now you have to check salary is an expense, so it is nominal account. Salary coming under nominal account. Nominal. Cash you know already, Cash is an asset, but here is no asset. Here you have to check whether it is personal, real. Asset is real. Asset is called real account. All the assets, accounts of assets and properties are real account. Now you can check whether salary debit or credit. Well, after that you have to check whether nominal account rule you have to apply. What is nominal account? Debit all expenses and losses, credit all incomes and gains. So salary is an expense, so debit. Why you debit? The rule applied, that means you can write here because it is an expense. Expense. Then real account, you know already, the rule you know already. Debit what comes in, credit what goes out. Here what happened? When you pay salary, salary or cash goes out. So when cash is going out, real account, once again, debit what comes in, credit what goes out. So credit. Credit real account. And why it is credit? The rule goes out. Goes out. So this is the rule. So this rule, if you find this, actually, I always suggest the many of the people or the students prefer to study only one approach. But I always try to teach them both the approaches, because sometimes this will be very easy. Traditional, in some cases, for example, a debit what comes in, credit what goes out. Debit the receiver, credit the giver. Receiver. So very easy to apply the rule. Some cases. So it is always better. I think, in my opinion, it is better you should know both the rules. But in most of the school, colleges, and everywhere, it is one approach. The modern approach is only teaching. In also in our ACCA handout or material, there is nothing about traditional approach. It is only their notes and only application of modern approaches. But if you understand both this, it will be helpful for you to decide easily debit and credit. But in practice, after understanding both this, then we will stick on one. For example, we can follow the modern approach only, or traditional approach. Whenever you think it is easier, you can apply. But we'll stick on the first one, traditional modern approach. So here is electricity also, two accounts, electricity and cash. Cash and electricity. Now, electricity, you know already, it is an expense. Expense is nominal account. There is no doubt in that. Nominal account is very easy. Nominal account, debit, nominal accounts are accounts of expenses, losses, incomes, and gains. Now, cash is an asset. Asset comes under real account. Real account. So, nominal account, electricity. When electricity nominal account rule is itself debit all expenses and losses. Electricity is an expense, so debit. Why you debit? Because it is an expense. Expense. Then cash is a real account. Then real account, what is the rule? Debit what comes in, credit what goes out. When electricity is paying, cash is going out. So credit what goes out. Credit what goes out. So goes out, or what goes out. You can write it is goes out. So now next one is repaid loan to bank 5,000 riyal. Before you took loan from bank, now you repaid the loan. Ragya. So just like before, what you have done, two accounts are, one is bank, but you write it is always bank account. You write the clearly whether it is loan or deposit. Then second account is cash. Cash. Now what is the bank is here is a personal account. Personal account. Bank is a personal account or person, and cash is a real account, you know already. Now personal account, when you repay the loan to the bank, personal account rule is debit the receiver, credit the giver. Bank is the giver. When you take loan from bank, bank is the giver. Here when you repay the loan to the bank, repayment is made, Bank is the receiver. So debit the receiver. Debit the receiver. Receiver. So now what is next? So bank is bank account or bank loan account, whatever bank or bank loan account will be debited because it is the bank is the receiver according to personal account. Now next is cash. Cash is real account. When you repay the loan, cash real account rule is what? Debit what comes in, credit what goes out. When you repay the loan, when you take the loan, your cash is coming in. When you repay the loan, cash is going out. So credit what goes out. Goes out. Credit what goes out. So up to here there is no any trouble, but here again goods return to NISWA. It is coming. Two accounts you know already. One is purchase return. Purchases return. Purchase return and NISWA traders. NISWA traders. This NISWA traders you have to understand in NISWA traders, it's okay. The customer name is always, you should know that, because in Tally, if you are using Tally or most of the accounting softwares, you have to write the account of the person. That means personal account is to be debited or credited. But in case of ACCA material and all, you have to understand it is a account payable or account receivable, or sundry creditor or sundry debtor. Sundry creditor, bills payable, account payable, or all same. So you have to understand both. NISWA trader is a account payable because before you purchased goods from them, now you return some goods to them. When you purchase goods from them, they are the person, they are your liabilities. You have to pay money. The person to whom you owe. So that all you have to understand. But here NISWA traders is okay. Now purchase return. Purchase return, you know already, purchase is always an expense. Expense is a nominal account. And NISWA traders, as you know, it is your liability. Liability. NISWA traders is your liability. So now next you have here there is a chances of confusion in a traditional method, a traditional approach. There is when here you have to understand, when purchase is considered as an expense, purchase is an expense. Purchase return, before we discussed already, expense decreases. Here there is no decrease. Expense or income, because in your rule is what? Nominal account, debit all expenses and losses and credit all incomes and gains. That is the rule. So when expense decreases, in T form account also most often, if it is some items are to be decreased, if there is no provision, it will be credited. A debit item to decrease, you will credit. Just like that, we will study later. Now you understand in nominal, in traditional method, there is only one rule. That is in modern approach, there is both increase and decrease you can write. Here there is no decrease. Whether it is an expense or loss, one rule, or income or gain, one rule. So here what you have to do, when expense is decreasing, it is the treatment is just like income. There is no decrease like an option. There is no option for decrease in this rule. So you have to understand, you have to treat as an income. Then here NISWA traders is a liability. So here there is no need to write. You can write here income. Income. Then here you know already it is a liability. Liability is what is here now the rule is what? Debit all expenses and losses, credit all incomes and gains. So it is a credit aspect. So it is a credit. Now you understand the Niswa traders. Niswa traders is a liability. When you purchase goods, your liability increases. When some of the goods you return to them, your liability decreases. So liability decreases, but here there is no matter of liability. You need not here. We went to the first modern approach. Here, Niswa traders is a personal account. It's another liability. You can think it is another case, but here there is only three accounts: personal, real, nominal. So Niswa trader is a personal account. Now you have to think goods returned to Niswa. So whether it is receiver or giver, personal account there is only one rule: debit the receiver, credit the giver. Now when you return the goods to Niswa traders are receiver. So you know already debit the receiver. So why we debit? Because it is receiver. So this is the account. Now here also this, but this two account I will show you after completing this. I will explain you an easy method to understand this. If you find it, but you understand the right way now. This is the right way we are doing. But an easy method, I will tell you an easy method to understand when there is return, purchase return or sales return. Now Salala traders return. When Salala traders return means you sold goods to them and they return. It is a sales return or Mobiat Raga. That means you sold goods, now they return. So or return inward. It is not return. Purchase return is called return outward. This is return inward. Dakhli. So two accounts are, one is sales return, and the second one is Salala traders. Now you understand sales return and Salala traders. Now you understood. Now the what is that? Salala sales return is also just like before. You have to understand it is a sales or revenue, or in that manner you need not understand. There is only three account here: personal, real, nominal. So sales return is sales is related to a revenue. So revenue comes under nominal account. Then here Salala traders is account receivable, or we can trade. It is a account receivable is what you call sundry debtors or account receivable. But here we have to explain three account: real, personal, real, nominal. So it is a personal account. Now what is that? Nominal account. This is also same as sales return. Nominal account. What is the rule? Debit all expenses and losses, credit all incomes and gains. But it is a sales is an income. When return income decreases. When income decrease, there is no treatment for decrease in this. There is no rule. There is no decrease in this rule. So decrease means you can consider as an expense. And personal account. So what is the rule? Expense. You can write this. Expense you can expense. So debit all expenses and losses, you know already. Debit all expenses. Now personal account. Salala traders return to you. When Salala traders return goods to you, that means to the business, Salala traders is the giver. So credit the giver. The rule is credit the giver. So these are the rules, but I always tell you to understand this returns case, you understand in different way. The first one, and it is a modern approach, it is very clear. Sales return, you see modern approach, this is purchase return, expense purchase. When return expense decreases, when expense decreases, it is credit. So here you can define very easily, or interpretation is very easy, but here the interpretation will be little difficult. So you understand in different way. In accounts there are two type of returns. Return means there is another return is there. There is a submission of return or tax return like that. That's not, that is another return. Income, revenue, there is another one. Here return means ragya. You are returning, you are sending back. So there are two type of returns. One is purchase return, sales return. You purchase goods and you purchase goods from a supplier, and because of some it's not according to your order or some defective, you return to the supplier. So it is return. So you have to understand here another word is there, return to Nizwa. Nizwa traders, to. To means ila. So when there is a word to, it will be purchase return. It will be purchase return or return outward. Just like Salala traders return or goods returned by Salala traders by. That means mean. It means return inward. Salala traders return goods to you, return inward. That means return inward means first you sell and the customer return. That means Mabiyat Ragya. Return outward. That means purchase return means Mushriyat, first you buy and return. Mushriyat Ragya. So these two terms very easily. So first you have to understand whether it is return inward or return outward, or purchase return or sales return. Then you understand like this: purchase is an expense, debit all expense. Purchase always debit. Purchase never come. Only exceptional cases it will be credited. That we will discuss later when there is a, when we are doing the final account financial statement. At that time we'll discuss. But you understand, purchase always will be debit because it is an expense, one thing, or it is a stock, is a current asset. Whether it is stock or expense, it will be debit aspect. So purchase return will be credit. Purchase debit, purchase return is credit. Just like that, sales is an income, revenue. Revenue always credit. One thing. Sales is a revenue, revenue always credit. Then sales return, it decreases revenue, so it will be debited. So do you understand like this? Purchase always debit, purchase return always credit. Sales always credit, sales return always debit. If you are very strong, some cases I see, I think always I like to make understand in this way. Some cases, some exceptional cases, you have to understand different way. You need not apply the straight rule, but at the same time you have to understand the rule. Right procedure you understand, but you use the shortcut. Some cases when we explain the all these up to financial statement, when we explain, I will tell you where you have to apply these shortcuts. One is this one. Once again I'll tell you, purchase always debit. Purchase is an expense, it is always debit. Purchase return, when it decreases purchase, so it will be credited. Sales is an income, revenue, sales, so sales will always come credit. So sales return decreases revenue, so it will come debit. Purchase debit, sales credit. Purchase return credit, sales return debit. Finish. Understand like that. Then it will be very easy for you. Now we'll do one thing for the time being. We have, I thought, to one more. It is a statement table is there. It is a little lengthy, and also there are 3 accounts are involved. It is little. We slowly will do one or two more session about this, the debiting and crediting. This, as I told you, always remember this part of accounting. The application of the rules of debit and credit is the most important part of accounting. Even more important than preparation of final account. Because for preparing the final account, preparing the trial balance, income statement, balance sheet, or fund flow, cash flow analysis, ratio analysis, everywhere throughout the accounting practice or accounting statement or wherever it may be, you need to understand clearly exactly which account is debit, which account is credit. What happens when increase or decrease? What happens like that? If you not understand, if you are not 100% correct about this area, this accounting course or topic will be difficult for you. That is one of the basic reason the student find the accounting difficult when they go ahead. This reason is you are not very particular about this area, very clear. So I always suggest you to be 100% correct in application of the rules of debit and credit. After that, no problem. After, if you are okay, you can you use shortcut always. But the base in your mind, it should be there. What is the reason? Why it is debited? Why it is credited like that? Not to by heart. It never by heart like salary is always debit like that. Salary is an expense. Debit, when expense or asset increasing, it will be debited. Or debit in a traditional, debit all expenses and losses, credit all incomes and gains. That concept you have to, that rule you have to apply. So anyhow, we'll stop here, and next class also will continue with this practical session. This is also practical calculation like that. We are not writing the amount here, but amount is, for example, here salary paid, and you understood now salary, debit salary account and credit cash account. So you have to write 200. That's all. Then, for example, here loan, bank loan and cash account. Bank loan debit, and this part you for understanding only. But the account is bank loan debit, bank loan credit cash. So bank loan debit 5,000, cash credit 5,000. That is the journal entry. So once you understand this debit credit journal entry or journalizing, recording transaction in the books of original account, original book in journal, it will be very easy. Nothing. It is nothing. Only you write debit. For example, first this March 12th repaid loan account. How do you write in journal? Debit bank or debit bank loan, credit cash, and amount is 5,000 debit, 5,000 credit. Both the amount column will be there in that, and you write a narration, a brief description. That you write the transaction saying repaid the loan, repaid the loan to bank, or repayment of loan. You can brief description about the journal. That is journal. So journal, how do you write journal? Once again, journal, there will be 5 column: date, particulars, LF, ledger folio 1 column is there. That's always blank. The page in which the respective ledger account is kept. No need to worry about that. You can keep blank, because in question there will not be the number of page number will not be given, or voucher number will not be given. So just leave it blank. So date, particulars, LF, debit amount, credit amount. There will be 2 amount column. So first you write what? That journal I will show you later first. But I want to prove that it is journal is nothing if you understand debit and credit. So first you write date. That means, for example, the March 12th March 2020. Okay. After that you write debit bank account. There you write loan, or that doesn't matter, because the once you got the debit means it is over. At the time until you get the debit aspect, you have to understand loan is a bank loan. It is a loan account. It's like that. But in details, when you're writing the account or in journal, you can write bank. So debit bank, credit cash, 5,000, 5,000, and a brief description about the transaction, that is narration. You can give repayment of the bank loan. Or if you find it difficult, you can write the same repaid loan to the bank. No need amount there in narration. That is called narration. So these are the journal: date, particulars, LF, debit amount, credit amount, and narration. Finish. Then go to the next. So now you will understood. You can make out. You can understand. This is nothing. Journal is nothing. The most important thing is to decide whether it is debit or credit. In your practical accounting also, I told you from once again the 6 stages: recording, that is journal, journalizing, and classifying, posting to ledger, and summarizing, talkhis, preparation of final account. That means trial balance, trading and profit and loss account or income statement, and balance sheet, statement of financial position. and analysis, tahleel, analysis also, analysis after interpretation. Analysis, there are so many tools we will discuss. Actually, this analysis and interpretation and communication, these three parts are not coming for your course, the diploma course. It is coming in mostly in advanced diploma and BTech courses. Different types of analysis, ratio analysis, fund flow, cash flow, common size measurement analysis, horizontal and vertical analysis. Like all these are coming later. So up to financial statement, final account will continue this, and the other things we will study in management accounting and different area. It is advanced studies. So make it first very clear up to preparation of final account, especially journal. So anyhow, I hope you it was useful. The session was useful for you. Thanks a lot.